Parikh, who's a chartered accountant. He's a manager at NISHIT Parikh and Company, Mumbai. He's a Master of Commerce from Mumbai University and an associate member of the Institute of Chartered Accountants of India. He has over 6 years' experience in advising several domestic and international corporates on matters relating to international tax FEMA and structuring of inbound and outbound investment. He also has a lot of experience in handling a wide range of cases at various levels. His areas of specialization are income tax, international tax treaty provisions, and FEMA. He has assisted various seniors in writing various articles and preparation for various presentations on various tax issues. We welcome you, Nishit. We request Mr. Vijay Bhat to give him our memento as a token of our appreciation.
Good afternoon, friends. I hope everyone has a very nice lunch, and I'll try to keep you awake for 1 hour 15 minutes with my ODI presentation. So what I'm covering today is what is ODI, what are the different routes through which an overseas direct investment can be made, what are the critical or important aspects to be considered in an ODI investment, what is the regulation regarding investment by resident individual, and also what if an Indian corporate want to set up a branch or a representative office, and then probably we can take up some case studies if time permits. So what is the importance of ODI for India? If you look at the trend analysis for 1999-2000, Indian ODI has been increasing. We generally hear about FDI coming into India, but Indian ODI has also taken an important role. Multinationals or Indian corporates are making their presence felt outside India. This basically we were second best to China in terms of investment which was happening from India to other countries. Also, this helps the government in improving the economic ties with the country. Because the investment is going to another country which is going to help that country, and also overall creates image of the Indian corporates overseas. So this is just a trend analysis which I have taken from RBI website. Here Singapore, Mauritius and Netherlands were the most preferred destination for ODI investments by Indian corporates. So this involves only direct investment details. So someone may set up a holding company in Singapore and may have a subsidiary in US or in any other country. But this statistics currently gives only the picture of direct investments made from India to other countries. What is the governing law around ODI and how do you interpret that law? Capital account transaction. Capital account transaction involves any transaction which alters assets or liabilities of a resident outside India is capital account transaction. So the moment I invest outside India, it will affect my balance sheet. It will come as an investment. So it is getting covered under capital account transaction. Capital account transactions are generally prohibited unless specifically allowed. And one of the regulation under section 6 specifically allows investment in overseas securities by a resident. So this is allowed. However, it is attached with some regulations which are popularly known as FEMA 120, and those regulations are updated on a time-to-time basis by RBI by various APDI circulars or notifications. And then other laws governing individual investment is governed by liberalized remittance scheme, which is very popular. We will be covering that also. So what is the meaning of ODI? ODI is subscription to MOA or contribution to the capital of a JV or a WAS, that is a joint venture or a wholly owned subsidiary outside India. It can be done through either a stock exchange transaction or through private placement in that entity or through market purchase or through investment like setting up an entity by yourself. However, portfolio investments are not included. When I say portfolio investment, it means any passive investment where I have just invested for some returns which are not related to my business, but any passive investment is not allowed. So as everyone would be aware, there is automatic route and approval route for investing overseas, automatic route is your boss or JV should be engaged in a bona fide business. Banking and real estate are prohibited, so I cannot enter into a banking business or real estate business outside India. If I am a financial sector company or I want to invest in financial sector, there are additional conditions provided under the automatic route itself. So if I satisfy all of these conditions, then I may be able to invest under the automatic route without approval. But for financial service sector, I may require additional conditions to be fulfilled, which I am discussing later on. One more condition is that Indian party should not be under RBI's exporters caution list or should not be under investigation by authorities such as ED, SEBI, etc. So the wording used in the regulations are etc. So what is covered in etc.? Today, if you look at the approach of tax authorities, they have been very aggressive. So search proceedings happening at an Indian company's office in Mumbai or in Delhi is very common. So whether that will get covered under investigation by an authority, it's something which is not clear. Regulations are not clear, but according to me, it should not get covered as such, because income tax cannot be considered as an investigation authority. Further, the investment which is to be made by the Indian company should be not exceeding 100% of its net worth. Earlier, this limit was 400%, which has been recently in August 2013 has been reduced from 400 to 100%. That was because of the way Indian currency was behaving. To stop the flow of foreign exchange outside India, this measure was taken. And last is submission of annual performance report in respect of its overseas investment. So whenever I am making an overseas investment, at the year end within 90 days I have to submit an APR form with RBI. So if I am looking to invest for a second time, they also look at whether for my first investment whether I am being compliant or not. So this was for automatic route. What happens to approval route? Under approval route, whatever is not covered under the automatic route should come under approval route. What does RBI do in an approval route? You have to make an application with necessary documents. They prima facie look at these 4 conditions. These are not sacrosanct in terms of these are just guidelines available. So this is not a rule or a thumb rule which RBI will definitely go through. But they would like to look at how feasible your business is. How will you be able to conduct your overseas business? What is the contribution to the country you are bringing in by doing this investment? What is the financial position and business track record of the Indian party and the foreign entity? Expertise and experience of the Indian party in the business which it is investing. So when I say financial position and business track record, so here someone may say that what about newly established companies? They may not have a track record. They may not have a financial position. So whether I can go under approval route or not. So here the answer is you will have to convince the RBI about your business plan, and based on the commercial expediency decision which they may take, they may allow or they may not allow under the approval route. But the funny part is under automatic route you need not prove this. So I am saying that under automatic route I can invest without having satisfying all 4 conditions, but under approval route I need to justify all the more. So as we discuss, additional conditions for the financial services sector is that it has to be registered with a regulator in India. Regulator, SEBI, if insurance company is there, it should be IRDA. The foreign company also should be registered with the respective authority in that country. The company which is investing should make profits from its financial services activities in last 3 years, and compliance to prudential capital adequacy norms. Prudential capital adequacy norms, they say that the risk which the financial service sector company is carrying on in India should be quantified, and based on that they may approve or reject, even though it is under automatic route. So they may have to satisfy whatever the benchmark is set by RBI. So if they don't satisfy, then probably you may need to go for an approval. These are other important points. So investment in Pakistan, if somebody is looking to invest in Pakistan, earlier it was prohibited. because of the relationship with Pakistan. But now, some 5 to 6 years back, it has been allowed but under the approval route. So even if you are satisfying all the conditions for investment in Pakistan, you still need an approval from RBI. Investment in Nepal can be done only in INR. So no foreign currency can go, you cannot purchase foreign currency and invest in Nepal, it has to go through INR. And for Bhutan, earlier it was similar to Nepal, but recently they have said that okay, in Bhutan you can also do in convertible currency. So now, whilst we are talking about investing overseas, who can invest? So an Indian party has been defined to include a company incorporated in India, a body created under an act of parliament. So here we can look at ICSI kind of body, a partnership firm registered under the Indian Partnership Act. So by plain reading of this, if I am an unregistered partnership firm, then I may not fit in this criteria. Any other entity in India as may be notified by RBI. And here again there is a question in terms of what is the status of LLP, whether LLP can invest overseas or not. So based on the plain reading of the Indian party definition, it is not prescribed, so it may not be able to invest. And what about a resident? We are talking about investment by resident outside India. Here if you look at the definition, resident is not included. So there is this controversy which was there earlier, where as per the section 6 of FEMA, it says any person can invest outside India, whereas in the notification of FEMA 120 they talk about Indian party. So people used to take a position that the moment I say the act is allowing me, so I can do it. And then later there were circulars and clarification which said that okay, it is allowed. So still, but this definition has not been changed. And there are special cases like what happens to proprietary firms, what happens to trust, what happens to unincorporated entities like AOP, BOI. Investment by proprietary concern. So these three which we discussed, I have taken one as an example, that for proprietary concern, some specific conditions have been prescribed by the government to say that if you satisfy all of these conditions, then you will be able to invest overseas. So condition is that it should be registered as a Star Export House. Star Export House registration means there are various exporters or manufacturers or many companies or proprietaries set up in EOU or SEZ units which can apply to become an export house, Star Export House. The same could be, there are different categories, Star 1 category, Star 1, Star 2, Star 3, and they have to satisfy certain conditions for investment. Like they should have track record of good exports, exports outstanding, receivable from overseas entity should not exceed 10% of average export realization. It should be high, it should have high performance export record. So basically this facility is given to only those proprietary concerns having high export track record, and the amount of investment does not exceed 10% of the average of 3 years export realization or 200% of the net owned funds. So there is a restrictive condition that whichever is less and not whichever is higher. Then when we talk about definition, when we talk about WAS, JV, what is a WAS, what is a JV? So here they have defined what is a WAS and what is a JV. Wholly owned subsidiary has been defined as a foreign entity registered or incorporated in accordance with the laws of the host country and whose entire capital is held by the Indian party. And for JV, not the entire but less than 100% I have to hold. So here the question is whether I can take an argument that WAS says a foreign entity formed, registered or incorporated in accordance with the laws of the country. So can I take an argument if that LLP overseas is registered and is in accordance with the law of the country, I can invest in an LLP? Because as such, if you look at WAS, JV, it is typically assumed that it would be a company. So here, based on the definition, if we can prove that a foreign entity is formed, registered and is in accordance with the law of the host country, then probably we can take an argument and see what happens. Financial commitment. So when I say that 100% of Indian company's net worth is allowed to be invested overseas, and what is that 100% constituted of? and what I can invest in. What it is constituted of, that we will come to later. But what I can invest in? I can invest in equity shares, preference shares. I can give loan to my JV or was abroad. I can give performance guarantee. 50% of the performance guarantee would be considered. Earlier it was 100, then reduced to 50%. Bank guarantee or letter of credit given by me on behalf of my subsidiary would also be considered in counting my investment overseas, and guarantee given on behalf of first step down subsidiary. So they are not talking about if I have multiple step down subsidiaries. If I am investing for the second leg or giving guarantee for the second leg, then it will not be considered as per the law as on date. So what I can invest, it is 100% of my net worth. What is net worth? Net worth is paid up capital plus free reserves. Paid up capital, someone may say equity, preference share is paid up capital. What about convertible preference shares? Because in accounting, if there would be someone who does a lot of accounting would know that that is classified as debt. So will I include that here? But if you look at FEMA regulation in terms of FDI, they have said that convertible preference shares, optionally convertible preference shares would be considered as paid up capital. So based on that we can take an argument, yes, it should be included. And for free reserves has not been defined what is included in free reserve. However, NBFC regulation defines what is free reserves. Under Companies Act 2 section defines free reserve differently. So it's like you can choose or you have to stick to FEMA since it is similar. I would go with the later one that FEMA is, since we are looking at a FEMA perspective, we will have to go to NBFC regulation rather than going to the Companies Act regulation. Then again in net worth, they say that while calculating your net worth, you may include net worth of your subsidiary, or if you are a subsidiary of your holding company, condition being there should be 51% stake. So if I am saying I have 100 crore net worth and my subsidiary has 50 crore net worth, I can look at taking 150 crores investment outside India, but I have to obtain and ensure that that company has not invested, and I can take a letter from them saying that I am not invested and you can use my net worth. So that is what is subject to letter of disclaimer. Then this broadly we touched up what are the instruments I can invest in, equity shares, preference shares. Yeah. Yeah. Yeah, so actually I have taken this as a case study, so you want me to take it up now or we can take it up later? So you are saying I have losses and my subsidiary has profits, or vice versa?
Yeah. It's just that I have losses and I want to calculate my net worth.
So how to do it? So yeah, we will take it up, surely.
So, if I have foreign subsidiaries, will I include that in the net worth?
I think so, 51% is the criteria. So it should, we should be able to, because it does not talk about, so sorry, it talks about Indian subsidiary, so it will not be allowed. Sorry.
I mean, it's 51% in Indian.
Yeah, sorry. It's Indian. And also they have specifically excluded proprietary concern. So if I am holding stake in some partnership firm or proprietary, that also I cannot do. So it's only subsidiary or a holding company.
But foreign.
No, foreign.
Indian.
So here again we've discussed what all I can invest in: equity shares, preference shares, debentures, guarantee. Then what if I want to acquire a company which is already existing in a foreign country? So where here they have said that if the valuation or if the investment is less than USD 5 million, you need to have a valuation from category 1 merchant banker or similar authority in that country. And if the investment is less than 5 million, then valuation of Indian CA or CPA of the overseas entity, overseas country is also allowed. And in case I am making additional investment, forget this criteria of 5 million less than 5 million. But if I am making subsequent investment, I have already investment in a company, I am making a subsequent investment at a premium or discount, then also I need to get a valuation done. That why I am basically to justify the rationale of investing at a premium or discount by the Indian promoter who is already holding a stake.
Sir, in the previous slide, you mentioned debentures. So can debentures go at the first tranche, or you have to have the equity shares and then you can issue the debentures?
So equity has to be there, then only
First
you will
equity has to be
have the criteria, and then this is the totality.
So subsequent investment into wholly owned subsidiary, that also has to be supported by a valuation.
If it is at premium or discount.
Okay, and if you have subscribed to a CCD and those convert, those also need to be
So if you have
supported
subscribed to a CCD or
of a WOS, and then
so that in that case anyways valuation would be done.
at the conversion or at the issue.
At the time of issue there would not be any valuation because it is allowed. At the time of conversion, if it is happening at a premium or discount to your original investment, then you will have to do it. Then the regulation also speak about that if you want to invest through a SPV, you can do it. They have not specified on the layers, so you can have multiple layers of investment through which you can do. But with the new Companies Act coming in, they say that 2-layer structure is allowed, and they have given exemption for company which I acquire overseas, which has multiple layers. So it says that if I acquire a company which is existing and it has multiple layers, then it is allowed. But they don't talk about if I invest and then I create layers. That is something once the Companies Act come into play, we will have to see how we can merge both the things or whether any amendment is made to those laws.
Sir, is there a restriction on number of subsidiaries?
Sorry?
Number of subsidiaries, is there any restriction?
In ODI?
Yes.
No, in ODI not, it is not there. But in Companies Act they have said 2 layers. Yeah.
Step down and there will be a restriction. But
Yeah, holding company we are talking about. It's an SPV. We are not talking about operating companies.
I
Sir.
have operating company.
Yeah.
So this is interesting because Regulation 13 talks about investment or creation of SPV, step down subsidiary, right? Now there it's not expressly coming out from Regulation 13, but if you read Master Circular, there the wordings used are creation of a SPV.
Yeah.
So that is where the confusion is,
Yeah.
because then if you really interpret that, they are only talking about a single layer SPV. And if that be the case, you cannot have more than, forget Companies Act, but then you cannot have more than one layer of pure workforce.
So, yeah, I agree what you're trying to say, but the problem is when you read it in isolation, there is a confusion.
No, and practically RBI has issued queries in some of the cases.
Where there is step down, multiple
Yes, second layer,
SPVs.
for the
Yeah.
second layer.
Okay.
Yes.
And to create a SPV, you again have to satisfy this condition that you are not on caution list or defaulter. So how do you fund your overseas investment? It can be through either of this market purchase. You can purchase the dollar from the banker and send it to your foreign company. You can capitalize your export dues, which are covered. What are the conditions on capitalization? Swap of shares. So see, I can have an arrangement that I will issue shares to you in my company, you issue in your company. That can be done, but since FDI gets involved, FIBB approval would be required. Now proceeds of ECB, FCB can be converted. Balance in EFC account can be used, and in EFC account there is no limit of 100%. That is what is specified in the regulation. In exchange of ADR, GDR, I can get the shares. If I have balance in RFC account, that is also what I can use.
In RFC account, is there a limit of 100%?
No, that is also not there in RFC account. Investment by capitalization. So here, if I have any dues left from a foreign company in terms of royalty, fees for technical services, commission or other entitlements, then I can convert that into equity. That is allowed under ODI. But the time limit for getting that dues back in India is 9 months. Earlier it was 12 months. So if I am doing this conversion after 9 months, I would not be allowed. Then I will have to go under the approval route, because then I am trying to do what is not directly allowed. So that is the rationale probably to put such a condition here. And in case the dues are outstanding for a period more than prescribed, yeah, that's what we discussed. What is the obligation of an Indian party? To remit funds, an Indian party for one single investment has to use one branch of AD for a particular overseas investment. So if I am investing overseas in say a Singapore company, ABCPT Limited, I have to do all my transactions through there. So here we had a very interesting case study where one of my clients had invested and they wanted to do after 6 years a subsequent investment. But at that point in time, they had changed their banking system. So the regulation says you have to go to the same branch. So what do I do? Then since we didn't have time, we had to actually go there, open the account in that bank again immediately and put the investment through there. But in other scenarios, probably what happens if the bank is shut or probably it's closed down, the branch is no longer there, then this all would become very practical difficulties which people may face. Then you have to receive share certificates or any other document as evidence of investment within 6 months. So some countries like Turkey don't issue a share certificate. So there probably you may need to check the entry in their registrar that XYZ has invested overseas and get that copy and submit with RBI. This third condition bullet is a very simple bullet, but most of us miss it because it comes as a footnote and it's not so relevant that 60 days, whatever services we are entering to our WAS or JV, whatever dues we have to collect from them, we have to receive it within 60 days of it falling due. Sometimes they have these intercompany agreements, but this clause is conveniently missed out. So this is something which also gets into the reporting in your APR, that whether you have collected or not.
Would this include exports also?
Exports, no. Dues, in terms of export, anyways 9 months time limit is there.
So the previous slide about the investment by capitalization, once you do the export, at any point of a time before 9 months you can capitalize?
Yeah, under the approval, under the automatic.
When you go to GR form, there is a specific column wherein you have to mention that this export receivable I am going to convert into capitalization. Then and then I believe this is possible, because once you do the export, then this 9 months time limit is basically not for the conversion of export into equity. I guess so, because under the form GR and under the regulation also they have specifically highlighted it has to be pre-intimation before export, not after export.
No, not necessary. What happens sometimes I have done the export. Then due to whatever problem the party says I don't have money right now. Then they may say that you take a stake in my company. But at that point in time,
it will be under the approval rule.
No, it would be under automatic rule, but you will have to fill a form ODI. The reporting is there. Even under automatic rule, reporting is there.
But how do I transfer my GR?
Because then GR will be, is right, because once you export, it is going to be GR documentation. So it will be an open document. So what I understand, under the form GR, there is a specific column itself where it says that if you are going to receive it or are you going to capitalize this export receivable.
So technically, if you ask me at the time of issuing a GR, I would be hopeful that I will receive the money. And so I will always say until unless there is an arrangement to capitalize it.
I'm saying this is under the automatic route. Once subsequent decision about conversion, would I guess
so you can probably intimate that I am going for this kind of capitalization, and probably then you may be able to close or cancel the GR.
Yeah, because then otherwise GR has to be closed.
That can be done. Then annual performance report has to be submitted within 90 days, that is 30th June for the last audited financial statement. So here again there is a problem in terms of in some countries like in India, I have time to do audit till 6 months, 8 months. But this I have to submit based on last audited statement. So I will have to complete my audit compulsorily within 90 days to comply with this. And if audit is not mandatory in that foreign country, then you may have to take a certificate from your statutory auditor in India.
Sir, I have a question regarding APR. If we read the original notification 120, the para says 60 days from the period ended